For thousands of years, civilizations have risen and fallen, empires disappeared. The money they relied on usually disappeared with them. History is filled with currencies that once seemed permanent. Today, most of them exist only in museums and history books. Gold doesn't. Thousands of years later, it's still here. So how did one metal outlast almost every currency humanity has ever created? The answer has very little to do with jewelry. It has everything to do with money. Today, most of us never question the money we use. We earn, spend, save, and invest it. It's simply part of everyday life. But for most of human history, money couldn't depend on governments to create trust. It had to earn that trust on its own. Gold did exactly that. What's even more remarkable is that this happened all over the world. Civilizations that never shared borders still reached the same conclusion. Gold made good money. Why? Because good money only needs to do a few things well. First, it has to last. If it falls apart over time, people stop trusting it. Gold doesn't rust or rot. A gold coin buried hundreds of years ago is still gold the day someone uncovers it. It also has to be difficult to copy. If anyone can suddenly create more overnight, it stops functioning as money. Gold passed that test too, but one characteristic mattered more than anything else. Scarcity. Gold is hard to find, it's expensive to mine, and no one can create it out of thin air. Even today, finding a new deposit can take years. Turning that discovery into a working mine can take even longer. That meant no one could suddenly flood the market with new gold. Nature controlled the supply, and nature moves slowly. That gave people something every monetary system depends on: confidence that the rules wouldn't suddenly change. If you spent years building your savings, you didn't have to worry about the supply doubling. Gold entered circulation gradually. It always had. People understood that. Modern money works very differently. Today, governments and central banks can expand the money supply whenever they believe the economy needs it. Gold doesn't work that way. Its supply follows geology, not policy. That difference helped make gold one of the most trusted forms of money in history. Not because it was perfect, because changing the rules was never easy. So here's the bigger question. If gold worked so well for so long, why did the world stop using it? If gold worked so well, why do most people think of it as just another investment today? Because somewhere along the way, we began treating money and investing as though they were the same thing, and they aren't. A good investment is meant to grow your wealth. A successful business generates profits. Gold was never designed to do that. It doesn't pay dividends or generate cash flow. That's why comparing it to stocks misses the bigger picture. Gold was never meant to make you richer. Its purpose was different. For thousands of years, gold did one job exceptionally well. It preserved purchasing power, while currencies came and went. New currencies appeared, others disappeared. Some slowly lost their value. Gold remained. That's why people trusted it for generations. Now imagine spending 40 years building your savings. You work hard. Stay away from unnecessary debt. Make smart financial decisions. By the time you retire, your bank account looks exactly the way you hoped. Then you realize those savings don't go nearly as far as they used to. Groceries cost more. Healthcare becomes more expensive. Housing costs more. The balance in your account hasn't changed much. What changed is what that money can actually buy. That's the part most people rarely think about. Money isn't valuable because of the number printed on it. It's valuable because of what it allows you to buy: food, a home, medical care, or the freedom to spend more time with your family. That's what money is really meant for. Economists call this purchasing power. It's simply the buying power of your money. Once you understand that, gold starts to look very different. People often ask, has gold gone up? A better question is, has the currency used to measure it gone down? Imagine using a ruler that quietly shrinks a little every year. Eventually, everything around you starts looking taller, not because the world changed, but because your ruler did. Money works the same way. When the measuring stick loses value, everything measured with it appears to become more expensive. Gold didn't create that effect. It simply makes it easier to notice. That's why comparing gold to stocks isn't really a fair comparison. One is built to grow wealth. The other has historically helped preserve purchasing power over long periods. For centuries, gold helped anchor the world's monetary system. Then everything changed. To understand why, we have to go back. To understand why everything changed, we need to go back to the end of World War II. Much of Europe had been devastated. Cities lay in ruins. International trade was struggling to recover. Countries needed a monetary system they could trust if they were going to rebuild. So in 1944, representatives from 44 nations met in Bretton Woods, New Hampshire. Their goal was straightforward: to create a system that could support global trade and long-term economic recovery. The agreement they reached shaped the modern financial world. The US dollar became the center of the new system. But there was one important condition. The dollar was tied to gold at a fixed price of $35 per ounce. Other major currencies were linked to the dollar. Gold remained the foundation. The dollar became the bridge between gold and the rest of the world's currencies. For a while, the system worked remarkably well. Trade expanded, countries rebuilt, and the global economy experienced decades of strong growth. But over time, that success exposed a weakness. As economies expanded, they needed more money. Governments spent more. More dollars entered the financial system every year. Gold couldn't grow at the same pace. Its supply increased slowly. Eventually, there were far more dollars than the gold that was supposed to support them. That made other countries uneasy. If everyone decided to exchange their dollars for gold, would there actually be enough? No one wanted to be the last country in line. Confidence in the system slowly began to fade. Then, on August 15, 1971, President Richard Nixon announced the suspension of the dollar's link to gold. The decision was presented as temporary. More than 50 years later, it still hasn't been reversed. That announcement quietly changed the rules of money. For the first time in modern history, the world's reserve currency no longer depended on gold. Instead, its value depended on confidence. Confidence that governments would manage it responsibly and that people would continue accepting it every day. Nothing dramatic happened the following morning. People went to work, businesses opened as usual, stores accepted dollars just as they had the day before. Life looked normal. That's why so few people realized how significant that decision really was. Its effects appeared gradually. Year after year, the consequences became more visible. Since 1971, the purchasing power of the US dollar has fallen by roughly 96%. In practical terms, $100 back then has roughly the purchasing power of just $4 today. The dollars didn't disappear. What changed was what those dollars could actually buy. Once money no longer had to be tied to something with a limited supply, creating more of it became much easier. That shift transformed the modern financial system. And it introduced a challenge that every economy continues to face: inflation. Inflation. Most people think inflation simply means higher prices. But higher prices are only the result. The real change happens to the money itself. Here's a simple example. Imagine an island with 100 people. The island has 100 apples, and together, everyone has $100. On average, each apple costs $1. Now imagine the number of apples stays exactly the same. Nobody grows more apples. The island doesn't receive any additional food. The only thing that changes is the amount of money. Instead of $100, there are now 200. Did the island suddenly become wealthier? No. There are still only 100 apples. The extra money didn't create more goods. It simply gave people more dollars to compete. Sooner or later, prices adjust. The apples didn't become more valuable. Each dollar became a little less valuable. That's inflation in its simplest form. Real economies are obviously much more complicated than a small island. Many different things can affect prices. Energy becomes more expensive. Supply chains break down. Wars disrupt production. But over long periods, the growth of the money supply plays a major role. That's what makes inflation so difficult to notice. It rarely shows up all at once. Your morning coffee costs a little more. A few months later, your electricity bill goes up. Then groceries become more expensive. Later, your rent increases. Eventually, it's the house you wanted to buy. Each increase seems manageable on its own. Together, they quietly reduce what your money can buy. Your salary may have increased during the same period. Your savings account may show a larger number. But bigger numbers don't automatically mean greater wealth. If your money buys less than it used to, part of its value has quietly disappeared. That's one reason gold has remained relevant. Nobody can suddenly double the world's gold supply. Finding new deposits takes years. Building a new mine often takes even longer. Nature decides how quickly new gold enters the market. Modern currencies don't have that limitation. When economies slow down or financial crises hit, central banks can increase the money supply to support the economy. Over long periods, this reduces the buying power. A modern economy needs flexibility. The challenge is finding the right balance. How do you support growth without constantly reducing the value of people's savings? That's one reason central banks still hold thousands of tons of gold. Not because they're trying to replace modern money, because some assets don't depend on anyone else's promise. If gold no longer backs modern currencies, why are central banks still buying it? After all, these are the very institutions that issue money. If anyone had complete confidence in a world built entirely on paper currencies, you might expect it to be them. Yet the opposite has been happening. In recent years, central banks around the world have been buying gold at the fastest pace in decades. That doesn't mean they expect the financial system to collapse, and it doesn't mean they're planning to bring back the gold standard. Gold serves a different purpose. Think of it as financial insurance. You don't buy home insurance because you expect your house to burn down. You buy it because the future is uncertain. Gold plays the same role. It doesn't rely on a government's promise, a company's performance, or another country honoring its obligations. That independence becomes even more valuable when the world grows less predictable. History has shown how quickly uncertainty can reshape the global economy. When uncertainty rises, countries often choose to keep a part of their reserves in an asset that no other nation controls. This also helps explain another trend you've probably heard about, de-dollarization. Despite the name, it doesn't mean the US dollar is about to disappear. The dollar remains the world's dominant reserve currency. It is still widely used throughout international trade. It still sits at the center of the global financial system. De-dollarization simply means that some countries want to rely a little less on a single currency. Instead of keeping most of their reserves in dollars, they're spreading the risk. Some increase their holdings of other currencies. Others settle more trade in their own currencies. Many are also buying more gold. It's the same principle behind diversification. You don't prepare for uncertainty by betting everything on one outcome. You prepare by making sure a single problem can't damage everything you own. That's how many central banks view gold today, not as a replacement for modern money, but as a stabilizing asset in an uncertain world. In other words, the institutions responsible for today's monetary system never stopped trusting gold. They simply stopped using it as everyday money. So what does all of this mean for you? Should you own gold, or is there a bigger lesson behind its history? The biggest lesson from gold isn't that everyone should own it. It's that everyone should understand it. Because once you understand why gold has mattered for thousands of years, you start seeing money differently. You stop focusing only on the number in your bank account. You begin thinking about purchasing power. You notice the difference between saving money and preserving wealth. Gold doesn't solve every financial problem. No single asset does. Every asset has a different role. Stocks are built to grow wealth. Cash gives you flexibility. Real estate can generate income. Gold serves a different purpose. Its job has never been to make people rich overnight. Its role has always been much simpler: to preserve purchasing power across generations. That's why it has survived for thousands of years. It outlasted empires. It outlasted financial crises. It outlasted thousands of currencies that no longer exist. The world will keep changing. New technologies will reshape the economy. New forms of money will appear. Financial systems will continue to evolve. But one question will always remain: what makes money worth trusting? That's the question gold has forced people to ask for thousands of years. And it's still asking it today. You don't have to believe gold is the best investment. Reasonable people can disagree about that. But understanding why generations trusted it, why central banks continue buying it, and why it still matters today, helps you understand something much bigger than gold itself. It helps you understand money. And once you understand money, you're far less likely to be distracted by headlines or swept up in the latest market hype. You'll recognize the difference between price and value. You'll think beyond short-term market moves. That's a perspective for life. If you found this video valuable, consider subscribing to Financial Cycles. We explore the ideas behind money and investing. Because the better you understand how money works, the better prepared you'll be for whatever comes next. And remember, if you don't understand gold, you don't fully understand money.